Let's bring in someone who can try to put this in perspective and explain just what it means for the company and for the stock. He's Michael Olson, senior analyst at Piper Jaffray. He joins us from the company's offices in Minneapolis. Michael, have you seen a company cut its guidance by 50% anytime in the past year? That's a big deal.
It is a big deal. No, I haven't seen that, and I think basically what they're doing is hitting the reset button. You know, they've shot themselves in the foot here, and they want to kind of lay a path to being able to beat numbers going forward, and I think that's what they're doing here. But it's probably largely dependent on you know, seeing the higher churn within the subscriber base, and that impacting subscriber acquisition costs. In other words, them having to spend more marketing dollars on retaining subscribers and acquiring new ones.
Hey, is there any chance that lowering the guidance is just sort of a one-quarter event?
You know, it's possible. I think there will be a sustained kind of impact of higher subscriber churn here for the next couple of quarters. You know, I think that there's a lot of moving parts in the Netflix model right now, and they're trying to do everything they can to just kind of, again, maintain the subscriber growth and maintain the ability to retain the existing sub base. And I think that's why we're going to see higher level of marketing spend or higher subscriber acquisition costs for the next few quarters.
Now, they also up prices that we all pay for Netflix. So will the increased prices offset the higher marketing costs, or are they going to eat the marketing costs in addition?
Well, I think the guidance would suggest that there's going to be higher marketing expense than what can offset the higher pricing. And I think the other thing that's happening is that a lot of subscribers are trading down to the streaming-only plan. And so you're going to see a lot of moving parts, like I said, in the model over the next few quarters. Ultimately, we're going to see revenue per subscriber actually moving lower despite the higher prices, as people do trade down to that streaming-only $7.99 a month plan.
Now, when you look at this stock as an analyst and you try to analyze the cash flows and figure out whether or not you can buy it or whether you might short it, where's your head right now? Where's your gut?
Yeah, you know, I think this will prove to be a long-term opportunity. We knew that tonight was not going to be an event where kind of the coming back to investors and feeling good about things we're all going to manifest itself at one time. So this is going to take multiple quarters to kind of heal the wounds that Netflix has put into the investor community.
Now, you're going to have to write a report tomorrow and talk about this stock. I know that this just came out, and you're going to think about it probably for the next several hours, but any idea what you might put in that report as a headline?
Well, I mean, I think that, like I said right at the outset, they're kind of hitting the reset button to kind of get themselves prepared for basically having upside potential over the next few quarters. And I think, you know, given all of the bad news that we've seen, it's probably the right thing to do to just kind of throw everything in with the kitchen sink. And it's probably going to be negative for the stock tomorrow, but the right thing to do to set a lower base going forward.
What's your low estimate for earnings for 2012?
Too early for me to know until we run through the model.
Could you try to take a stab at it? I mean, do you cut them in half? Do you lower them by 30%?
Yeah, we're not going to cut it in half. It'll be lower, but I don't know what the number will be.
Do you suspect that you'll maintain a buy on the stock?
Yeah, we're going to maintain a buy. I think, like I said, long term, this will prove to be a buying opportunity. It's obviously been painful for investors over the last few months, and it'll be likely painful again tomorrow. But like I said, I think they're hitting the reset button here.
Now, let me also ask you, because I'm a Netflix subscriber. I love the service. I'm not entirely happy with what's happened recently. But look, they lost the Stars movies. That expires, I think, in about another 6 months. So is there any risk that they lose some of the access to their other movies?
At this point, most of the contracts that they have for kind of Tier 1 content is those contracts are not up for any near-term renewal. And so I think Stars is going to be the only major content loss that we see anytime soon. But, you know, they're starting to backfill that with other new content. Some of it, unfortunately, won't hit for a little while, like the DreamWorks deal that they signed that doesn't kick in until 2013. But they're definitely working to backfill that content library and improve the streaming content that's available.
What about competitors like Amazon now getting some of the video from PBS or just Hulu in general? What do you make of that kind of competition?
Yeah, those guys are going to spend more, and they're going to be more competitive. I don't think they're going to spend to the degree that Netflix is spending to improve the streaming content library. Even with all the money that Amazon's spending today, they have 0 of the top 50 movies of the last 2 years. So the content library is still fairly poor, and it'll get better, but I don't think it's going to get better overnight for those competitors.
All right, Michael Olson, senior analyst at Piper Jaffray, thanks for joining us from Minneapolis. We will let you go now and go write your report. And for all of you who are watching,